All right, so let's move on, Kev. Let's talk about the top 5 things to watch next week. And so, what I wanted to start off with is talk about sector rotation a little bit. And now, I'm going to just say it right here. Please do not get into your bond rant. And give us your. Do not preach about the great bond bear market that's coming, and I told you so, and all this shit.
Hey, I
Let's.
never say that. Those 3 words, I never
Oh,
say.
oh my God. Okay, anyway, just
I
let's talk sector rotation with the
Okay.
idea that interest rates are going higher without you going into your rant. Okay,
Okay.
so but with that said, uh, a short-term top is in bonds, and yields have been going up. So we have seen the 10-year yield. Let me just pull it up over here on a chart. Where do I have it? But anyway, the 10-year yield's been working its way higher. We're almost at 2%. And we were down as low as 1.4%, and interest rates are going up. Now, one of the things that we have seen on bonds has been that as interest rates went from like 3.3% down to 1.4% throughout 2000 and the first 3 quarters of the year of 2019, um, all of the bond proxy sectors of the stock market worked so spectacularly well. So when you owned REITs, you owned utils, you owned consumer staples, there was alpha there. Like those were the sectors that were outperforming in some epic way. And ever since we've seen the short-term tops in bonds, and short-term, I'll say, and you're not allowed to say anything else, but with yields backing up, uh, the rotation has begun. So the thing is, do you think that that's it now? Are we going to see the XLU, like utilities as an example, and the REITs and all these others, and home builders, are all of these now going to, on the short term, be giving back huge amounts, and they'll be the sectors that underperform?
Yes, except for one sector.
Oh my God, stop it.
No, I honestly believe that the home builders will be okay even with a rising rate environment, as long as the rising rate environment is caused by economic activity. And I think that people have been hiding in REITs and utilities, and that this trend is just the beginning of it. And I will posit that we will see this trend of these sectors underperforming continue for the next year at
Are
least.
you are you do you and you think that that's the same situation for consumer staple, or less so?
Yeah,
Obviously the REITs and utils are no
yeah. So the
brainers.
utilities are the kind of the ones that seem to be hiding in the most. But Patrick, I think the answer to your question is: will this rotation continue? Yes. This is just the start, Patrick.
This is start. Okay, there you go. Everyone heard it here. Kevin is calling it.
Yeah. Listen, we could get before we go. We could obviously get a bounce. We've gone all down a long way, but if you're asking me three
Oh
months
yeah,
from now,
no, no, no. I'm sorry. You
yeah,
don't start shorting the utils here after 2 weeks straight down, right? You got it. You need. There's going to be a
yeah.
bounce.
Well, there might not be, but if you're asking me if 3 months or 6 months they're going to be lower, I'll say yes.
Okay. So by the way, I agree with that. I don't know about a year, but I do believe that for the rest of this year they'll underperform. I
Okay.
think that's a fair assessment. So anyway, next week on Friday is an option expiration, and normally we don't bring up option expiration. Sometimes when it's quad witching or something, we'll bring it up. But particularly what I wanted to talk about was some of the extremes in dealer and option positioning going into this expiration. And so I have some charts here from Numara and as well as from Spot Gamma. And what we have here is a chart that is showing the sum of the S&P and SPY Gamma all within 1% of the spot price out 6 months. We're to the 90, almost to the 96th percentile of Gamma. And on a delta basis, we're like to the 97th percentile on the delta exposures. And what we continue to see is a pretty extreme positioning in the options market. And we're going obviously into usually the monthly expirations carry a larger open interest than the weeklies. What's your take on this? Do you think that this is going to impact us going into next week?
Well, so let's just take a moment and kind of explain what people mean when we say that the delta, the gamma, is this as high as we've been in a long time. Like, why is that? Basically, most clients are sellers of call options out of the money, and then buyers of put options out of the money, down and out. And the reason they do that is because they want to basically protect against a fall in the stock market. So what they do is they buy out of the money puts, and then to pay for them or to gather premium, they sell out of the money calls. Now, we've just had an epic rally in the stock market. We screamed higher. What this means is that those calls that that the clients sold to the dealers are actually become in the money, so that the dealers are now in a situation where at these strikes they are long gamma. And what long gamma means is that as the stock market goes up higher, they are get longer, and as it goes down, they get shorter. This is as opposed to think about it when they sell the puts. As it goes down lower, they get shorter, and as it goes higher, they get longer. So when we're kind of short gamma, when the dealers are short gamma, they end up exacerbating any moves in the market, because the reality is as it goes down, they need to sell more, and as it goes up, they need to buy more. So they create volatility in their hedging strategies. Now, it's the opposite when we get into a situation where they're long gamma. So what will happen is as it rallies, the dealers are selling delta, meaning they're selling to hedge their positions. And then if it were to fall, they're there to cover that short position because they're still long gamma. This has the opposite effect. Instead of making it more volatile, it makes it less volatile. So when we talk about this effect and why this is important, this is why people like Charlie McElliott from Nomura talk about this so like all the time, because it has an effect of either making a stock market that is volatile even more volatile, or making a stock market that is calm even more calm. Now, what he's saying is because we've rallied so far, the dealers are long tons and tons of gamma. So therefore, that is muting the price action.
Yeah. So we're pinning. We're gonna pin here.
And listen, it probably will be pinned, and will probably grind higher. And the reality is that eventually that will reset as we spend more time at these levels. What you will find is clients will take off those positions,
Roll them up.
And then also the puts that'll be bought. Instead of now buying a 3,000 put, they might, instead of buying a $2,900 put, they might buy a 3,000 put, right?
And that's going to change the profile.
That's going to change the profile. And so this is part of the reason that vol is generally offered as we go higher, because of the way that the hedging works within the kind of index community. So do I think that this option expiration is going to be a big deal? No. In fact, I would argue that we will see continued muted action as we go into these expiries. Now, after that, though, let's just imagine that we get this rolling off. Then those effects are removed. And not only that, they have to hedge. A lot of times what they will be doing is buying new puts and selling new calls. And that is generally a delta negative effect and stuff like that. So I would say that when I'm looking at this, I just think it helps explain why we're in a situation where the market is actually relatively calm. Like, I think that I've seen on Twitter a lot of traders complaining about how boring the market is right now.
Yeah, and it very well next week it will continue to be boring. But what will be interesting is that as we get into the latter part of November and into December, and especially into the next Fed meeting, the volatility might return. And so it'll be interesting. The odds are, on balance, it's probably going to be a boring week next week, unless, of course, some unknown catalyst is introduced that throws everything out of whack. But everyone should be planning for a surprisingly boring week.
I don't disagree, which means it's probably going to be exciting as hell. But having said that, don't forget December has traditionally in the past been exciting, and let's see what happens. I know a lot of people are looking for return of 2018. I'm not so sure that we're going to get that, Patrick. I actually, would like to take a moment out here before we go any further to say, You have been arguing that we were headed higher. I think you've consistently said that for the past month, and you've been bang on correct. You wanted to be bearish, but the trader and you said that you thought that
Yeah.
we could rally, and we've rallied way farther than anyone would imagine, except for you, or not except for you, but you've been spot on that call, and now we're getting some people that are getting bullish as we go higher, which is always the case. But you know what? Maybe you're correct about your call being that this squeeze gets even worse going into year end. And, it's a topic for another show, but I really think that there's a lot to be said for the fact that this reaction by the Fed in terms of to the problems in the repo market has created a lot of liquidity sloshing into the market at a time when, when you combine it with the world, bouncing in terms of the whole global economy bouncing, we're getting a situation where it's almost a perfect storm to the upside.
So what was interesting is Jimmy shared with us obviously the levels that like we could go up to even 3,300 and 3,350. There are definitely Fibonacci extensions that go up there, and I've shared them with my members. But I'll tell you, this 3,100 level is particularly interesting because if the S&P 500 for some reason was to top out at 3,100, then that could easily become like the head of a head and shoulders pattern and a bigger topping formation. I would say on balance of probabilities, I still think we probably go higher. But if this is a very important level to watch. If the, I don't know if we've been up here too long for it to be a prairie dog, but this 3,100 is a key technical level. Keep watching it anyway.
Well, there you go, folks. Listen to Patrick. He's been on fire lately with his S&P calls.
All right. So number 3, I wanted to talk the breakdown of these IPOs. And I'm going to start with the IPO ETF, which does not reflect how bad the carnage truly was in some of the most popular names. But this is that Renaissance Greenwich Funds IPO ETF. And this thing went from 34 down to 28. It's a basket of them. But some of the biggest
Okay,
ones.
but wait 1 second, Patrick. Though the one thing about this is, yes, it doesn't look that bad, but you have to remember that the market's screaming to new highs.
Yeah.
So on a relative basis, this is actually crap. Like,
Oh yeah.
yeah.
You don't want to be and that's interesting because usually you would think that in a bull market when everything's frothy, the IPOs should be where the money is flowing, right?
Yeah, but it's not. And so although you're saying that the IPO index or this ETF isn't looking that bad, you have to remember that on a relative basis, it's looking terrible.
Yeah.
Not only that IPO that ETF, the way it's constructed is actually the IPOs from the last 2 years.
Yeah.
So you're getting, it's not really like it's not a reflection of the most current hot IPOs because it's basically anything that's come to market over the past couple of years averaged out. So you're not getting the true crazy names, which you're about to walk us through. So why don't you start us with the first one?
Well, I just want to highlight 2 or 3 of these, right? So Beyond Meat, which opened near $40, rips to $240, has gone from $240 back down to 80. It's just given all of that froth, and we were talking about the short carry, right? In terms of it was just extraordinary what was going on there. But this IPO just got murdered.
Yeah, I know, but you know what the funny thing is? The short carry was so expensive. I don't know how much money you made.
Almost none.
Well, I don't know. You still probably made money, but it was definitely hard when you had like what was it, 100% carry?
No, what do you mean? It was like 200% at one point.
Yeah,
it was crazy.
Yeah,
and so, but look what happened to Uber. Like, I mean, Uber IPO'd, popped to like near 40, went as high as like 48. Down to $27.
So I got a story to tell you about Uber before you do anything more, Patrick.
Yeah.
I have some kids, and one of my kids is a young kind of entrepreneurial young fella, and he basically looks for deals that he can arb, and he figured out a way to get his friends on Uber Eats, and he made like almost $100 a free food by getting them to go on their Snapchat stories or I don't know, something like this. He had some scam figured out where if they bought something, they got something, and he got something. And I thought to myself, Uber Eats, like they think they're buying customers with these kind of promotions. They're buying 14-year-olds that have the time to share their Snapchat stories. It seems to me that they're just throwing money out in kind of like they're just like they have a wad of $100 bills and they're like, here, you take it, you take it, you take it, you take it. And those aren't real customers. This guy, my son, is not going to be buying any Uber Eats anytime soon. Like after the promotion is gone, he's never going to use it again. So I think that they have just thrown money out the window. I think that they're a perfect example of just when the stock market is valuing growth way too high. And interestingly enough, I was just having breakfast with him, and he was telling me a story. And I told him I said, the stock's been having some trouble. Why don't you check if that promotion's still on? Well, guess what? It's gone. And it's because their stock market is no longer allowing them to do it, right? And they figured it out.
Oh, there you go. And the next one I wanted to touch on was Pinterest, right? And that, again, IPO'd like $24, popped to 37, now down to 20. So, I mean, all of these hot IPOs, all of these unicorn darlings, other than Beyond Meat holding above its initial price, most of these IPOs are already, anyone who owns them, they're underwater. And so there's been a lot of pain in this space. And so while we see the S&P ripping, and maybe the S&P still goes higher, it's amazing that the underlying core of the froth, some of these areas are rotten.
Well, so Patrick, I will tell you that that's a function of the real froth being in the private markets. And this is something we've talked about in the past, but these private equity markets with the WeWork and all these different kind of crazy unicorns trading, 7 big behemoths like venture capital and mutual funds trading amongst themselves at ever higher valuations. The fact that these IPOs are having trouble is more of a reflection of reality starting to sit in on that market. And I don't think it actually means that the stock market has to go down. I think it's a return of sanity in those markets. And I think WeWork is a perfect example of the craziness that was happening there. And I don't think you necessarily need to read in because WeWork started to get priced correctly that the stock market has to go down. And in fact, maybe the reason that the public markets are ripping so higher is because we're getting a situation where the private markets are getting sold. Who knows?
Yeah,
they're
You're
just
right. That makes sense actually. It's possible.
You sound surprised that something I said makes sense.
No, it's honestly the private equity has been a bubble. I mean, there was a couple of really good videos. You shared some different stuff with me. Actually, we shared it with our listeners last week, right? But that definitely is a dynamic that's developing, and I don't think it's going away. It's anyway. Number 2, we were talking about next week is the inflation number.
Oh.
Is that when you're going to concede?
Yeah, I'm not looking very good on my inflation call. We're already
you're looking awful. Actually,
we're getting our 5 listeners.
I
together.
thought I gave you a gift.
I think we're at 4 now, and we're getting everybody ready because I think that I'll be conceding early, and we'll be going for a December drinking where I concede that the fact is that inflation did not go above 1.9. I still think that that it was the right bet to take, and that we're going to go forward. You're going to look back and you're going to be like, you skated just on side there.
Oh my God! All right, okay. You know what? We're going right back to the trading couch. You know what? This is we're going right back to sitting you down, and Dr. Seresna is going to talk you through this problem you have of letting go.
That's right. Well,
this is a call you're making that's going to take you down.
Touche.
You're on a
touche. I will.
So
say
retail
touche.
sales. Any comment? Anything that you're thinking?
So you know me, I've been bearish on the economy over the last little while, and actually getting a few right. I think that we could see a situation where the worst is behind us, and at the very least, these numbers are going to start to come in line, and that eventually going forward, we're going to start to see them exceed expectations. So I'm going to start saying that we're back to a situation where these might actually surprise to the upside. There you go.
All right. Well, you heard it here. You know what? I actually feel that in general that we have a scenario where the economy things look so bad for so long, and there's room for a lot of these things to uptick. And so in my mind, we could have a scenario where all of the repetitively bad negative data in Europe and US all stall out, but I still think we're late business cycle, and this is not a recovery. This is not the new growth cycle that's beginning, and so even it's just going to be noise. Is my opinion anyway. But you're right. It probably is not going to downtick in this in next week's number. Anyway, number one, let's talk about the bear steepening. And so, for our listeners that are not familiar with this, what we're talking about is the differential of interest rates at different spots of the curve. And in particular, we're now looking, at least the chart I pull up here is the difference between the 2 year yield and the 10-year treasury yield for U.S. government treasury bonds. And one of the patterns that well, one of the trends that's been in place for 3+ years has been a flattener where we've seen the inversion of the yield curve. And what we have now seen in since September, as we've seen the beginning of a steepener. And the question I'd like to offer here is, have we seen the beginning of the steepening?
So, Patrick, I have to tell you a story. I watched this actually really great interview, and I was surprised because I've always saw this particular strategist, and I've listened to his crazy Bitcoin calls, and some of his some of his other fundamental calls, and I thought that there wasn't much behind his thinking. And I know you're not a fan, so you're gonna like throw up in your mouth a little bit when you hear this, but I actually watched Reform Broker interview Tom Lee, and
Okay.
I was actually shocked at how when he wasn't calling for 40,000 or 50,000 Bitcoin, a la John McAfee style or whatever, he's actually made a lot of sense. I know, and no, honestly, I was quite impressed with him. I never,
Oh,
I know, and you know what? Maybe it's just we haven't given him a chance. But listen, one of the things that he said, he had this great line, and I just pulling it up on my phone as we were chatting here, and he said, "People are carrying around 2008 hammers looking for 2008 nails." And
okay.
I think that's a great line. I think, you know what? In part of my, I was on the couch telling you stuff. I feel like that you should also, if somebody that we, previously not respected starts saying things that make sense.
Listen, as long as he comes on and doesn't talk Bitcoin, we can have him on the show.
I don't think he's going to want to come on because we've done a few WTFs on him. So I'm not sure
Way
he's
too
going to.
many,
But
actually.
listen, Tom, if you're listening, we're always pleasure. We're always willing to listen to the other side of the view. That's one thing about us. We put up with each other's point of view all the time. So we're obviously
And we won't shit on you on the air, just behind your back when you're off the air.
no, no. Listen, and we
Just
kind of
kidding.
make fun of ourselves more than
Oh,
anybody
yeah.
else. I will say,
We
that's the one thing. But
listen.
I
We
actually
shame
listen.
each other.
I found him making a ton of sense.
Okay, so
And
what did he say? What did he say about the curve?
well, not much. I don't know. Like he's like I wasn't listening
Well, we're
that close.
talking about the curve. This is number one. We're talking about the curve.
It's
What
like
are you bringing up Tom Lee
my wife
on the
tells me that I don't listen and I don't pay attention or something like that. I wasn't really
Oh my
listening at the
God.
time.
So is the curve steepening, Kev?
Okay. Anyways, the point is that the reason I brought up Tom Lee is that I think you guys got yourselves in an orgy of like recession is imminent and it's going to be a 2008 style thing in the summer. I like you guys really took this to a stupid level, all the bond bulls. And I will agree with you that there is a chance that all we've seen recently is a normalization of those crazy bond bullishness.
Okay.
So I'm not saying that we're off to the races and that we're headed straight up to 200 basis points, but I will tell you this. that if we look over the coming years, that the risk is going to be that this curve goes way wider and way steeper than anyone ever imagines, and that the surprise will be.
So you're talking bear steepening, though. Like you're thinking, yeah, of course you're talking bear steepening. I wouldn't even have to ask this. Don't forget it.
Yeah.
Don't
Well,
pretend
so
I didn't say anything.
no,
Of
but
course
like
it
I
is.
kind of I like to me, I'm not sure if they leave the front end flat and nothing happens to the front end and it just all the sell off occurs in the back end. What is that? Like I don't know. Is that still a bear steepener?
Yeah.
Is it okay? Well then,
Yeah, it is.
then I love
It's
the bear.
it's about the long end moving, right? And so the bear steepeners, sorry, the bull steepeners, where it's the Fed cutting. It's the Fed funds going to zero.
Okay, yeah. So of course I yeah. I
You're,
just don't think the front. So listen, I
so,
don't.
but okay, do we get can we easily get to 50 to 70 basis points on a
Yeah.
2 pence?
For sure. Listen,
No.
this is absolutely insane that we are thinking that we're not going to have inflation and that there is that it makes sense. Oh, anyways, I know I hear
We're
you
going
sigh.
we're
No,
going
you know
back
what?
on
I
the trading
promise,
couch.
I promise.
We're going
But-
back on the trading couch.
Yeah. So listen,
You have a problem, Kevin.
no, I do have a problem in that the opportunity is huge. That the market is missing a secular change in inflation at this point, and it's going to be a series of these moves. But on the whole, the real danger is not being bearish enough on bonds and getting cute and like sitting there and saying, "Oh, I'm gonna get a bounce here because of some Fibonacci or
Oh,
some
Jesus.
triple bottom or some crazy
You know what?
thing."
I all right. You know, Kev, you had your 2 minutes. That's
Anyways,
you're
back to-
going to
back
be.
to the-
You know
back to-
what's going to shock you is listen. At some point, okay, I'm not going to get into a long rant. I'm just going to say this. At some point, you will be right. Because I don't believe that we're gonna I don't think that me and you are gonna be at our old age home, heading to the golf course 40 years from now, and we're still gonna have zero interest rates and inflation never came. At some point,
But wait. Most of your other bond bulls do believe that because we have the
Okay.
triple Ds.
okay, so at some no, but at some point there will be inflation. What I am convinced though is you are just way too early, and we're gonna be on our 3rd-year anniversary, our 4th-year anniversary on the show, and you're gonna be still doing the same boogeyman rant. Inflation is coming, and one day you'll be right, but everyone's gonna be so sick of hearing it that is like no one's gonna give you kudos. You know what? That's my call anyway.
Okay,
all right.
so listen. I will say one last thing. I am sure you're correct that most people will be sick of listening to me whenever that occurs. But listen, I will say one thing. This is millennial degenerate. You know, too many beers for me. I can't read. But anyways, at Jesse Livermore, he wrote this, and I actually thought this was a great, wise tweet that he put out. This turn in boons, because I actually think that the boons are driving way more, the German boons. This turn in boons reminds me of when an excited reporter asked Grant Williams about how the top in the Nikkei unfolded in late 1980s. And Grant answered, well, it went up and up and up, and then one day it stopped going up. And I really think that we're going to look back and we're going to feel the same way about it. And you will realize that the fundamentals will come afterwards. And one of the dangers is that that you have to look at this price action and you have to be worried because this thing is not trading. It's trading scary, don't you think? No, you don't think?
No. I mean, when you had German bonds go from 70 basis points to minus 70, you're going to get a reaction of 30, 40 points the other way as just a reaction. There is nothing scary about this price action yet. You don't have me at all worried.
So I will agree with you that this could get that the real scary part is still to come. I agree with you there. I completely agree that people
You're
are
just
getting
you're
like
just doing a victory lap on the first
I'm not
reaction.
doing. I don't do victory laps.
Oh,
I don't
oh,
do victory laps. I'm not doing a victory lap because the reality is that I was wrong while the thing was going rallying in my face, and I kept calling it. And I'm going to do a victory lap when the thing goes to record wides on the yield curve, or the rates really sell off. I'm
All
not
right.
playing this for a move for 30, 40 basis points. I'm
right.
playing this for a big move. So I'm not doing any victory lap. And I'm just saying that I'm thinking that the surprises will still be to the upside in terms of yield and down in price. And I think this could get a lot worse.
All right. You heard it all here from Kevin Muir. I'm gonna let you have the last word because then otherwise this will never end.